I'm going to start buying a brand new stock, and I'm going to build this into a pretty darn big position. We're about to get into what stock this is. I had a position in the stock a while back, took some short-term profits on it, didn't really build it out. I'm fully committed to I want to build this into a massive position. We're talking about, am I about to start this position tomorrow, next week, next month, why I'm excited about the stock over the many coming years, why I want to build it into a serious position, all those sorts of things, okay? A lot to go through in today's video. We're going to talk about that. We're going to talk about a lot of other stocks, some earnings that came after the bell, a few other important things I want to draw to your guys' attention, okay? Appreciate you joining me. Thank you for being subscribed, folks. Thank you for being here, okay? So first off, another tremendous day for small caps, right? Revolve was up over 10 percentage points here today. Honest was up almost 10%. It was up over 9% today. JWN, which is just, I think, slightly over a small cap, but still gets grouped in with small cap stocks. That one was up 5% here today. Avant was up 2.5%. All my best stocks were small caps, right? And on the Twitch live stream, I did this beast, 3-hour live stream here today on Twitch. I was listening to some folks on CNBC Talk, and including Tom Lee and a few others, and folks are definitely coming around to the small cap side. I can tell you that. They are starting to get pulled over one by one by one, and Wall Street's slowly getting pulled over to the small cap side. And they showed this. I thought this was pretty darn shocking. This shows you call options activity for the Russell 2000 ETF. Call options are starting to explode, in specifically, really in the past month. That's specific, okay? The past month, all of a sudden, people are starting to get really, really flipping flapjack and bullish on the Russell 2000. I mean, if you look at the Russell 2000, there's been minimal call action activity in the Russell 2000 for the past 4 years recently. And then all of a sudden, this past month, all of a sudden, it's going to the moon. Now, what the important thing to understand about what you're looking at in front of you right now and what this means, what the implications are for small cap stocks, folks, is that small cap stocks are likely setting up, it's no guarantee, but they're likely setting up for a beast 2024. Looking at how much call option activity is starting to come into these small caps, I'm just telling you, this is usually a pretty good indicator of massive bullish momentum coming in the underlying shares of these companies in 2024. What you're going to likely see is more and more Wall Street money positioned into small caps as we get into the first half and even probably the second half of the year. Remember, every one option contract represents 100 underlying shares there. And so if you start to see that sort of call option activity, the next thing coming is really starting to buy the shares. And we're already starting to see that play out. Some of these small caps are already rolling 50%, 100% just in the past month. I mean, Honest is a good example. Honest is up over 100% in the past 1 month. These are pretty extraordinary moves, but the thing you got to understand is we're likely still a little early innings in regards to this move. They also showed this. I thought this was kind of important. This shows you how kind of tough the market, tough of a place the market's in right now. This is where we're trading at right now. So this shows you the percent of stocks within 10% of a record high. Right now, we're at very low numbers. Not as low as we were certainly at the beginning of the year, but we're still at very low numbers as far as the percent of stocks within 10% of a record high, okay? Usually, when you're getting way up here, you usually just went through a very bullish market, and you could be ready for a little come down, let's just call it that, in regards to that, okay? Now, next up here, what I'm showing you is the Russell 3-year performance, is a 3-year stack performance versus the S&P 500 and versus the Qs, otherwise known as the NASDAQ, right? The NASDAQ 100. So when you look at this, the Russell in the past 3 years is down 2%. S&P 500 is up 25%. Qs are up about 30%. And so you got to understand, there should not be this much divergence between these three. There should not be, okay? This doesn't mean it has to outperform the Qs, but it has to be somewhere roughly in this range. Maybe at up 20%, up at least 18%, something like that, or it could outperform and be up 30%. But this is too much, okay? There's a lot of catching up to do, and you only get this catch up to happen one of two ways. You need the NASDAQ stocks and S&P 500 to crash, right? Or you need the Russell to play a lot of catch up here in the crash scenario where the Russell doesn't really go down, but the other indexes get hit, or it's the Russell rolls in 2024, does much better than the S&P 500 and Qs, which is probably what I'm thinking, and ultimately the Russell gets somewhere more in that range, right? What you're looking at now is even a more stark contrast here. 5-year performance of these three versus each other. You got the Qs up 141%. You have the S&P 500 up 74%, and you have the IWM Russell up only 28 percentage points. That should not be like that, folks, and that will not last. That will not last. It never does. It never does. This baby, once again, either these two are coming crashing down or this one's coming in and playing catch up. One of those two scenarios is playing out. There's no in between. That's an important thing to understand about this, okay? Very, very important. Next thing, I saw this on the front page of CNBC today. This absolutely blew my mind. But it doesn't really surprise me. Check this out. So, front page of CNBC. AMD stock spikes after company launches AI chips to rival NVIDIA. I'm like, what? What are we talking about? AMD showed off their chips yesterday, and the market was open yesterday, and they had showed off their chips. So if you were excited about what got shown off yesterday, you would have bought the stock yesterday, not today. So the fact that the stock moved huge today just shows you Wall Street makes moves when Wall Street wants to make moves. They showed off all their chips yesterday. You could have bought it yesterday. Wall Street said, no, not yesterday. Today's the day we go out and buy it, even though we already knew the information yesterday, right? And so AMD has this massive day, up nearly 10 percentage points here today, right? And it just shows you like how fixed of a market it really is in the short term, right? Because, you could have thought, okay, yesterday's going to be the booming day, and yesterday AMD stock's down, despite them showing off all those chips. There's no new information that came out. We knew all this. But today, Wall Street decided, today's the day we move this baby up big, right? And, this is why it's so important to be a long-term investor in this game, not screw around with trying to beat these Wall Streeters in the short term, because you won't beat them. I can tell you that. If you're trying to beat them in the short term, you can destroy these guys over a longer term time horizon, but you can't beat them over the short term. It's they're going to move stocks when they want to move these stocks. It's just bottom line, okay? And so, I showed this in a video recently. This is if you buy the market and however long you hold it for, and the performance, or not the performance you're going to get, but the likelihood you're going to make money. And if you hold for only one day, 53% of the time you're going to make money, which is still cool that you make money more than you lose money, but that's only for a day, right? Versus if you hold the stocks for a year, now we're talking almost a 74% of the time you're going to have your money, let's just call it, be raised up. It's going to be worth more than what you bought in at, right? You take it out to 10 years, now you're at about 95%. You take it out 20 years, and you're at 100% of the time, right? Take your time horizon out a little bit and destroy these Wall Streeters, because at the end of the day, if you're an AMD shareholder, right, and you're in this for the long term, you got to prosper today. Even though they already knew the information yesterday, today you got your 10% up day, right? If you're a trader out there and you're thinking the stock was going to move big yesterday when they showed it off, and then you go ahead and you say, okay, AMD didn't move, it was actually down, I'm going to go ahead and short this baby into tomorrow, and so you go ahead and short it yesterday, right? Thinking, okay, there's no momentum here, it's got to sell off probably harder, and then you get a 10% pie in your face today. Come on, man. Come on. I saw this. This is crazy. I don't know if you guys have seen McOvervalued. McDonald's is going to open this thing called Cosmix. Yes. Have you guys heard about this? Have you heard about this? They're going to open this concept called Cosmix. McDonald's plans to open 10 locations of Cosmix, a new spin-off brand, to test whether the concept would work across the United States and other markets. The burger chain is positioning Cosmix as fast, convenient way to grab a pick-me-up snack or coffee. So the first thing I thought about is like, what is this, like a wannabe Starbucks? Like, what is this thing that McDonald's is trying to do here, right? And so they're talking about they're going to sell things like Egg McMuffins and McFlurries here. And so I'm like, okay, why not just open a McDonald's? Like, if you're going to sell several of the same products you sell at McDonald's, why not just open a McDonald's instead of one of these Cosmix, okay? But this is what they're pitching it as, and really branding it as like coffee as well. And it just cracks me up. I remember when I worked at Quick Trip back in the day, right? And, we had really transformed the business model into much more around like coffee and tea and snacks and selling pretzels and, pizza items and all these different sorts of things, right? And we transformed the way the outside of the stores looked. I mean, this way the outside of the stores used to look like basic, kind of decent convenience store into like these beautiful architecture, that's a masterpiece for a convenience store chain, right? These stores are beautiful and, try to transform the business model. So I don't know what McDonald's is up to here. I guess they're trying, I don't know if they're trying to compete more with the Quick Trips or the Starbucks. It's hard to understand what they're really trying to do here, but it's a weird situation. One thing I do know about McDonald's is the stock. The problem with McDonald's is it usually trades at pretty high multiples. I mean, you're 22 times in the stock, almost 23 times next year's expected earnings. I mean, that's up there. For a name like McDonald's, that's up there, folks. That is, Yeah, McDonald's is kind of a well-established company, let's just put it that way. We had a bunch of earnings after the bell. Lululemon reported earnings, C- quarter for Lululemon. Good revenues here, okay? And by the way, I posted all these in the income statements tab inside the Private Stock Group's Discord chat, so everybody can kind of learn, how to judge these income statements and what's good, what's bad with them, things like that. So really exciting as far as the net revenues for Lululemon. Gross profit was up very nicely year over year, $1.2+ billion gross profit versus a little over $1 billion in the same quarter last year. As a percent of net revenues, 57% gross profit. That's good. That's the signals and signs you like to see. But where Lulu ran into some troubles and why the stock's having a little trouble here is selling general administrative expenses up considerably. That's up to 38.2% of revenue versus 36.8%. So SG&A is a little out of control for these guys, okay? So income from operations actually was down for the company on a year-over-year basis. Now, some of it, impairment of assets, restructuring costs, that's part of it. But still, bottom line is income from operations down. As a percent of net revenues, down to 15.3% versus 19% in the same quarter last year. And net income for the company actually fell. So, it was a very, kind of mixed bag income statement where the top half is really exciting, but then you go deeper, and once you hit SG&A and below, that's where it starts to get a little depressing. So very strange kind of income statement there with Lulu here in the short term. Another company that reported after the bell, DocuSign, which I'm sure you've probably used DocuSign if you've had to sign anything electronically in the past here. DocuSign's definitely getting their business model in a much better place, let's call it that. They reported, I would call it a B+ quarter here. Subscription revenue up pretty nicely year over year. Professional services and other was down. Total revenues was up about $55 million year over year. Subscription, professional services, cost of revenue was roughly what you would expect it to be. Nothing crazy there. Gross profit came in at $557 million. That's versus $515 million in the same quarter last year. That's impressive. Sales and marketing, they dropped that considerably. They dropped that by about $20 million on a year-over-year basis, $21 million on a year-over-year basis. That's, if you have your revenues go up that much, when your sales and marketing expense went down that much, that's a pretty darn good sign. R&D, they spent quite a bit more on R&D, but I circle that a blue because, if you spend a lot more on R&D, hopefully you should have some great new products and services coming down the pipeline, right? General administrative, a little out of hand there, up to $108 million. But overall, if you look at their income from operations, up to almost $20 million versus about a $27 million loss in the same quarter last year. So they flipped from an unprofitable company now to a nice profitable company, right? Net income was up to $38 million. That was helped by this interest income right here, $17.6 million. So overall, DocuSign headed in the right direction. Good for them. That stock's been leveled. I mean, that was a stock that was close to $300 back in 2021. And today you can pick up shares for less than $50. So just one of a lot of stocks that got absolutely wrecked, okay? All right, next stock up here. This is where things are going to get interesting, okay? RH, if you look at their income statement, absolutely positively, it's an F quarter for RH. There's no debating that. It's an F quarter. Everything was red. Revenues down substantially year over year, well over $100 million. Cost of goods sold up to 54.7% versus 51.6% in the same quarter last year. Gross profit fell to 45.3% of revenue versus 48.7%. That's not good. SG&A, selling general administrative expenses, up to 38.5% versus 28.8% in the same quarter last year. Ooh, boy, okay. Woo-wee. Income from operations was only 6.8% versus 19.6% in the same quarter last year, which, by the way, this same quarter last year was also a very poor, bad quarter for RH. This wasn't like this was some amazing quarter, the quarter they reported last year at this time, okay? This is bad. Interest expense, 7.3% that's up to for the company versus 3.7% in the same quarter last year. Net income is now a net loss. $2.1 million net loss they had versus in the same quarter last year about $98 million of net income, right? And obviously they had an EPS loss here, okay? So, I mean, the income statement's an F. It's an F grade income statement there, right? Now, in terms of how it's being pitched by financial media, it's also not good. RHC's housing market frozen, delays catalog as it swings to surprise quarterly loss. Promotions will create a shift toward clearance products, pressures gross margins. RH says that's not good, not good, not good. Revenue fell to $751 million from $869. The analyst survey by FactSet expect RH to report revenue of $757 million, so they missed by about $6 million on revenue. RH experienced increased headwinds in early October when mortgage rates peaked above 8%, and the Middle East conflict, seriously, come on, RH, like, don't blame it on the Middle East conflict. Come on, man, be better than that. That was the one thing I was disappointed. I'm like, dude, none of us are buying that. Yeah, you didn't sell as many couches because the Middle East conflict. Come on, give me a flip and flapjack and break. The company continues, quote, to expect the existing housing market to remain frozen until interest rates and or how home prices fall meaningfully, it said. So Gary Friedman talked about still a very tough next 6 to 12 months, which I'm not surprised. It's a very tough 6 to 12 months. Now you may say, well, wait a minute, Toll Brothers yesterday, wait. Toll Brothers reported some pretty good order numbers. Toll Brothers seems like they're doing fine. Keep in mind, the new home market is a very small segment of the overall housing market. So the home builders are still doing okay simply because people don't have options. The people that want to buy a new home just simply don't have options out there because existing inventory is so low in markets. So a lot of people are going with a brand new home being built. And plus, the home builders are offering all these incentives, these builder credits, and also interest rate buy downs and all this stuff that you're just not getting really in the existing home market right now. And so that's benefiting the guys at Toll Brothers. But keep in mind, for a company like RH, they need overall luxury home market to be moving, people moving, because if people are moving, there's a decent probability they're going to be able to in the market for new furniture, which is going to bode very well for a company like RH, right? Additionally, the home furnishing market has become increasingly promotional, and we believe that will create a mix shift toward clearance products, pressuring gross margins. Operating margins were below expectations due to higher than expected expenses, including international store openings, costs related to a pending acquisition of the New York guest house property, and unsuccessful efforts to secure the iconic One Drive Miami Beach location as well. Now, stock's getting hit pretty hard after hours. I'm sure it'll be down big tomorrow. As far as after hours, it's lost $25 a share. It's down over 9 percentage points. We'll see, where all the fallout is in regards to this one. If the market was weaker, I think RH would be under $200 right now, just to be honest. I mean, let's say this year wasn't such a good year for the S&P 500, I mean, there could be a potential where RH would actually be under 150. But I think since the market's been overall in a better place this year, it's helped a lot of stocks like in RH, okay? Now, I'm reading, some of the commentary out there. This person on the message boards, Ashley, says, CEO is such trash, no clue how to run a company, what a rookie. And interesting thoughts, because sometimes you read some of this stuff and you got to say, okay, is this factual or is this baloney? Let's just call it that, okay? So what do we find here? Well, first off, when Gary Friedman came over to RH in 2001 and became co-CEO at that time, the company was like nearly bankrupt. Like they were nearly a done establishment. Okay, they were nothing like the RH today, this huge luxury brand in the furniture space or anything like that. They were nearly bankrupt. And then he took this company public back in 2012, right, from the private markets. And since that time, the stock is up 778%. Yeah, I wouldn't call that CEO a rookie. I wouldn't say he's a bad CEO at all. That's pretty tremendous performance. I mean, if you tell me I can buy stock and over the next 11 years, that stock will return me 778%, I will take that every single time. And twice on Sunday, as they say, okay? Abso-dang-lutely. Let's pull up a 7-year performance. Let's look at the past 7 years of RH versus the strongest big tech companies everybody talks about. NVIDIA, Apple, Microsoft, Amazon, Google, McDougal. Check this 7-year performance out. The only stock of those stocks that beats RH is NVIDIA. NVIDIA is at a 1,600% gain in the past 7 years. RH is at 941%. It's trashing Apple, which Apple's at 540%, which is still tremendous over the past 7 years. Like, once again, if you tell me I can make a 540% on a stock over a 7-year span, I'm taking that, okay? Microsoft's up 473%. So RH is basically a double up of Microsoft's performance over the past 7 years. Amazon 256%, Google McDougal 247%. So yeah, I mean, this whole CEO's trash. He doesn't know what he's doing. He's a rookie. You know, the only question I doubted Gary Friedman on in recent times was the huge buyback he did recently, and to deplete the balance sheet of so much cash to do the buyback. Outside of that, I think this man's one of the smartest CEOs in the world, literally. I think what he's doing there is phenomenal, and the stock price performance speaks volumes, because remember, we're in a huge, massive downward market in the luxury home market. So keep in mind, RH stock today, if we were in a normal luxury home market, RH would probably be even outperforming NVIDIA. That's a little food for thought. And there was a time period when RH was significantly outperforming NVIDIA before the housing market got absolutely destroyed, right? This was last year. This was posted January 2nd, 2023. Luxury home sales plummet 38%, the biggest decline on record, driven by inflation, recession fears. That was last year, right? This year, I haven't seen much good news about the luxury home market, just to be honest. Luxury home purchases sink record 45%, the second lowest record on level on record. Luxury home prices post double-digit drops in the Bay Area and Seattle. So, I mean, from what I've seen out there, it doesn't seem like the luxury home market's necessarily, booming this year either. This is going to be likely another horrible year for luxury home sales, maybe even worse than last year. We'll see when all the numbers shake out and when the numbers come out in January, right? Which, shows you that we're just in an extremely weak time for luxury home sales in general, right? And that's not going to stay like that forever. Eventually, the luxury home market will get moving again. Is it 6 months from now, 3 months from now, 12 months from now, 18 months from now, 24 months? That's a big debate. I can tell you what's going on in the stock market definitely bodes well for the luxury market. I will say that, okay? Things I love about RH is you can't duplicate what they've done. With what they've done with their brand, their stores, you can't duplicate this. You don't have the supply chain for it. You don't have the money to invest in their stores and invest into the brand. Like you can't do this. Like, who else has got this sort of money to spend to build these sorts of luxury, massive, epic mansion stores? Like, no one else is doing that. You can't do that. You can't afford it. They're the only ones who can do it and are willing to spend that much. It's kind of like a Nike situation, right? Who else has, the sort of money to drop $500 million or give an athlete $1 billion contract if they're a big athlete? No one other than Nike, right? And you say, who's got the money to build these sorts of stores and build this sort of brand? No one other than RH, right? This is their new property they opened. I call it a property rather than a store because it's more of a property than anything. RH England, which is absolutely just an epic. I mean, that's an RH. Like, how crazy is that? Like what am I seeing here? Like, what? Who else is doing this on the branding side? In positioning the brand like this? I mean, it's insane. They're doing things like they opened the RH Guest House in New York City, and this is a very exclusive, they call it a guest house. Some could call it a hotel. It's got I think it's only got 8 or 10 rooms total. It's got a penthouse, a couple suites, and a couple regular rooms, and that's it. I think it's literally less than 10 rooms at this place, and the rooms go for $2,200 to $15,000 a night, essentially, at this place. And they have this beautiful restaurant that's at the establishment as well, right in New York City. And, just a super high-end restaurant with super high-end food. And so it just goes to show you, they're positioning the brand almost like a Louis Vuitton, above, anything anybody else is willing to invest or put into their brand, just to be honest, right? And the other thing I'm really impressed with for RH is, despite it being a horrible time period for the luxury home market, right, and a really tough time period for their business model, they've actually stayed profitable this year overall, right? $116 million in net income. I mean, for the 9 months so far through the year. So even if they take another loss in the next quarter as well, which is certainly a possibility, they'll still have been a profitable company in one of the worst luxury home markets you'll ever see in your life. Absolutely extraordinarily bad. I mean, you could ask the company, would they rather have a recession where the Fed drops rates down to 1% or 0? And they probably would rather have that, because at least then people would be moving, which gives you some activity and some opportunities to sell some dang high-end furniture. If people are moving, it's a tough situation, right? And I can tell you, as a customer of RH, right, almost all the furniture in my house is RH. There's really nowhere else I can go for high-end furniture that I would look at, in that sort of lens of, RH versus all these other companies, I'm going to go with an RH every single time. And so my next house, guess who's going to furnish it? RH. And when you do a big home with RH furniture, you're going to spend 6 figures plus. They were just talking about they got a new client in Europe, and $330,000 they're spending on a property in the French Alps right now. $330,000 in furniture. It's very common for an epic home, that person to spend $300,000, $500,000, even up to $1 million in just furniture as somebody like an RH. And that's really who you're going to go with. And they're really in with interior designers as well, which is phenomenal. So I want to start a position in RH. Absolutely. The question is, when do I want to start this position in RH? Is it tomorrow? Stock's going to be down huge tomorrow. Is it next week? Is it next month? Is it next year? What am I thinking here? Okay. Well, my thought is I'm going to start a position likely in 2024, and then I'll build that position to a very large position, brick by brick by brick, throughout 2024. And so, my opinion this year, I still got to focus on a few other stocks that have my attention and time right now. But I will likely start a position in RH in 2024 and build that baby brick by brick until it's a big position, because I really like this company. I really like where Gary Friedman's taking it. And as a long-term investor, I can look past the horrible luxury home market we have right now. I do not think it's going to be like that forever. And I do believe when the luxury home market starts to come back to life, which it is a potential, it starts to come back to life at least a little bit in 2024, I do believe RH is going to benefit absolutely epically from that overall. And so I definitely want to start a position in this. But I will be buying other stocks tomorrow outside of RH. And if you want to see the moves I'm making tomorrow in the market, join my Patreon, pin comment down there. It's only $19, covers you for an entire month. You get to see the moves I'm making every single week. You get to be part of that Discord chat. I mean, that's a no-brainer, man. No-brainer for $19. Come on, man. That's a steal deal. So, yeah, I will be making moves in there in literally hours from now. Okay, that's pinned comment to join me on in there. Okay, much love and have a great day.